Good morning. Welcome to IG's early morning call. It's Thursday, 18th of January. Let's take a look at the headlines as we see many of the European markets pretty much hold on to recent losses, big losses in the London markets the last couple of days. Today, we've got the focus very much on the retail sector. We've got numbers coming through from Currys, from Dunelm. They're Christmas trading statements, and it'll be interesting to see just what's under the covers there for those companies. Cranswick, outside of that, the pig farmer and sausage maker. Wow, that's really doing well. Let's take a look at what else is happening across the markets on this Thursday morning. The concerns about oversupply in the nickel market coming through this morning from BHP. That stock is down relatively heavily on the Australian markets. And as we look ahead to what's happening in oil, as we'll see on the charts, not much move, but there's quite a bit of news around on both sides of the supply-demand metric. Let's take a look at volatility. Yesterday, we were talking about this big spike in volatility, not too far away from the highs, 1545, still below the 20 level, which is the point at which many regard the point at which traders become a little bit more excited. So we're still some distance from that. But if you look at where some of the trades are at the moment, we were talking about the short trade on the London markets. What I've done is I've expanded out this fib because I had the fib down here. And then I pulled it right the way down, actually, because to be fair, this is the move. Yesterday, we were very close to 76.4% retracement. A little bit of a bounce in today's session. I don't see much reason for that, I have to say. These markets at the moment, insofar as where we closed out yesterday's cash session, you can see we're absolutely pretty much on the money as to where we closed out yesterday's trade. If anything, it's just a couple of points on the bag on the upside. But to be frank with you, what's happening here in the markets is that London, consistently the underperformer in the markets last year. This blue box represents the point at which we started and ended the year. So you can see now we're technically speaking below where we started out 2023, not quite as low as we were at the low point at 72.15, but at 74.41. These markets looking pretty weak. If you get a candle close below the 73.78, you then take the short trade all the way down to the 72.57, which will give you the total retracement of this move from the lows we had back on the 27th of October. Now, we're talking about trading this on the short side and bringing your stop loss in. And if you've been doing that, there's a fair bit of money have been made on the downside. Let me take a look at the 4-hour chart just to give us a better idea as to what's been happening. Overnight, a little bit of interest in the markets, but broadly speaking, going to the back end of yesterday's session, we saw some relatively hefty declines. And that's really where I think I wanted to focus on what's happening. You can see before on the 4-hour chart, we've had these little mini rallies. And the markets are just emptied out again. There's a couple of problems going on here. First of all is that the Bank of England, when looking at the potential for interest rate cuts, we are now seeing further evidence that inflation is remaining sticky. And quite honestly, the Bank of England is finding it, I think, is going to find it tough to find a reason to cut interest rates. That's exactly the message we heard yesterday from Christine Lagarde across the Eurozone. So I think in some respects, we're both in the same sort of basket. And as much as inflation is not going away, and it's meaning that any interest rate cuts are likely now to be postponed. And that, of course, is the mantra that's going on as well in the States. Anyway, that's where the FTSE is at the moment. The German DAX, broadly speaking, has been a far better performer. This blue box is all of last year's trade. And we are only just on a relatively small retracement in what has otherwise been a really good back end of last year. So the DAX is down, up in today's session, but broadly speaking, down over the last week. And not too far away from holding on to the losses. French CAC 40, same sort of story, down, but not nearly by as much as we see in the London markets. In today's session, we've got an interesting set of buying. In fact, we're now up a little bit more on from the close last night, so expecting possibly a slightly stronger start to the French markets at 73.34. Let's take a look at what's been happening elsewhere in the markets as we look to what's been happening overnight in the Asia-Pacific session. Nikkei 225, after those really big gains in the first week or so of the year, we're not too far away from those recent highs with a marginal drop in today's session. The Hang Seng Stock Index seeing some relatively speaking, impressive gains. But don't forget, we've seen some 2% losses, 3% losses recently, concerns about the internal economy in China, spooking many investments in the Hong Kong markets. S&P ASX down 0.2% on the trading day in today's session. Wall Street closed yesterday. It's an interesting message coming through from Wall Street, where we see the tech stocks picking up on the downside. The Nasdaq at the close of yesterday's session, not too far away from 0.75% loss. But if you look at the 24-hour markets, The loss was actually recovered. We got a fairly long candle wick on the downside yesterday, which indicates to me we were well off the lows. And in fact, in today's session, we've seen some interesting buying. So despite the fact we've got many markets around the world showing losses, the NASDAQ, in fact, the entire Wall Street complex is really holding up quite well. S&P 500, long-term picture. Look at this. Not even as low as we have been in the last couple of weeks. Beginning of the year, 5th of January, saw that low point at 7,400. 7,439 is where we're trading at the moment. A little bit of buying interest in the 24-hour markets in the US, looking ahead to the start of today's session. Same sort of price action on the Dow after 5 days of losses. A little bit of buying interest. Yesterday's low point was the low we saw not seen since the 21st of December. But again, it is only a small retracement in what is otherwise a market that's, broadly speaking, holding on to recent gains. Let's take a look at what's been happening overnight in the Asia-Pacific region for economic data, because we've seen some more Aussie data coming through with Aussie jobs. Surprisingly strong growth, actually, in the jobs market in the Australian economy. The unemployment falling sharply in December. Net employment down 65,100. It was the first drop in employment in 3 months, as full-time employment tumbled by 106,000. Part-time employment rising by 41,400. Now, that's not the sort of employment that any economy or any Treasury Minister wants to see. They'd far rather have a lot more people going to full-time employment with secure jobs in the long term. But clearly that's not happening. We know that from anecdotal evidence in other economies around the world. Jobless rate unchanged at 3.9% from November, holding the highest reading since May 2022. Talking about stats, looking ahead to what's happening in the States a little bit later on today. Building permits and housing starts for December. Philadelphia Fed Manufacturing Index in January. Initial jobless claims as well coming through in the week. Let's take a look at what's happening on the foreign exchange markets and bring all those stories together. I drew this Elliott wave on the US dollar yesterday. Within this channel, downward channel, we got the recovery underway. I've drawn a little bit of a question mark here because I don't know where it's going to end up. Yesterday, we found out a challenge to pass the 200-day moving average on the dollar basket. And the dollar basket is down as well today. But in fact, interestingly, euro dollar is holding up for a second day in a row. We're off the highs. But we managed to see support around this box here between the 61.8% and 76.4% retracement of this move from the lows we had back on the 8th of December. We tried but failed to get below the 200-day moving average yesterday, and the bounce came on from that. And in fact, interesting enough, yesterday there were no sellers in the market at the close, and in fact we managed to beat up above the 108.83 previous line of support, then resistance, and now support again. We're trading at 108.92. Where it goes depends on, I think, more of what we're getting in terms of some of the evidence coming through from the economies in terms of what's going on. Retail sales in the States tomorrow, which is going to be a really interesting number, I think, to watch out for this euro-dollar trade. I was just talking about what's happening with the Australian dollar, because with that jobless number coming through today, a little bit of buying interest on the Aussie after hitting this line at 65.25, which has been the area of support of interest to watch out for. You can see it's previously been resistance and support established back on the 7th of December last year. So that was always going to be an area of interest. And in fact, that held beautifully. Trading below the 200-day moving average, Aussie dollar, very much, I think, really being steered by what's happening with the US dollar. Just picking up on what happened this time yesterday, we were talking about stronger than expected CPI data in the UK. Relatively strong day for sterling yesterday, holding on to that and building today at 126.88. But I think more interest for me is what's happening with sterling against the euro. This time yesterday, we were listening to what Christine Lagarde was saying. She's the chief of the European Central Bank, saying that interest rates aren't going to come down as quickly as many had been hoping for because of this sticky inflation. But in fact, the euro is losing out to a slightly stronger sterling. Yesterday, relatively strong sterling, all the way up at levels not seen since the 12th of December. But broadly speaking, today, holding on to that at 116.84. If you're long on this, stock goes underneath recent price action with a view to taking it up further. And I think that's the possible trade to go with sterling stronger against the euro in the mid-term. So we're waiting on that US data out a little bit later on today to give us some more indications as to what's happening with the dollar trade. Just want to update you as well on what's happening with the dollar against the Japanese yen. We've been following this on the upside with the dollar stronger against that weaker Japanese yen. And this has been one of the motors, I think, behind that move up on the Nikkei 225 a weaker yen. Plays in well to those large exporters. Today, a little bit of a rowing back into some of the performance we've seen recently at 147.86. Yesterday, intraday, highest trade we've seen in the dollar against the yen since the 28th of November last year. Now, corporate news headlines, as I was saying at the top, it's all about UK retail today, I think. A couple of stocks worth watching this morning. Currys, I'm not completely convinced it's a particularly good story. But if you read the RNS this morning, excuse me, they do, pardon me, they do seem to indicate that they're happy with what's happening around their numbers. Group like-for-like sales, though, down 4% in the first half. They talk about peak like-for-like revenue in UK and Ireland, but that was down 3%. They said strong sales in mobile was offset by weaker trends in TV and computing. The company says robust profits, though, delivered through stable gross margins and continued cost savings. Let's look at those margins. They were higher despite intense competition, according to the company, through what they say was a better balance of sales and margins. Now, the current year guidance, group adjusted profit before tax, according to the company, is expected to be between 105 and 115 million pounds. That's ahead of consensus, according to the business. But to be honest with you, I'm not completely convinced that the markets see it that way. And if you only go look at one snapshot of where this company has come from, the highs we had back in 2016, all the way up at £5 a share, we've seen 91% loss. That's value destruction in this company. And yesterday, we very nearly went through this line at 43.3, which is the recent lows onto a recent record low, then bounced back. But I don't see anything in this statement today that fills me with any joy, particularly for this company. So let's switch on to what's happening else in the high street. Dunelm. This is the company which sells items from bedding to sofas, chairs, garden furniture, and so forth. It forecasts its annual profit to be in line with market expectations, reporting a 1% increase in second quarter sales to £483 million. Analysts on average expecting profit before tax for the full year to come in at £202 million. Strong sales growth in the first half, with total sales increasing by a margin of 4.5%. Continued sales growth in the second quarter in a challenging market, it says, with total sales increasing by a margin of 1%. Well, let's take a look at what's been happening on the Dunelm chart. Recently on the way down, it's been a particularly poor start to the year so far, where we started at £11, we're now at £10.43. The stock on the way down. In yesterday's intraday session, we saw the lowest print on this stock since the 9th of November last year. Longer term picture, it looks like it wants to drift lower. Technically, we do have some support. Let me just quickly draw that line down there. Support at 964 if you're looking for an area of support to watch for on the short side. If you are short on this, stock goes above the 200-day moving average at around about the £11 level. £10.43 is where we're trading. £9.46 would be a price target on the downside if you think that things are building on the downside. Don't forget that consumers are finding it tough. They're looking for bargains. So when companies do sell, like Dunelm do sell, more often than not, they're selling into a market which is giving them smaller margin growth because they are releasing a lot of goods on the market at discounted prices. So this is another thing I think it's worth looking at. Staying on the charts, just wanted to update you as well on Sage Group, one of the UK's largest software companies. It's going great guns recently. And in fact, if I just quickly pull you in a chart showing you what's been happening with this company, in fact, I think it looks like it's an all-time record high. Indeed, that's what's been happening. We've got some support at 10.54. We're opening at 11.52. First quarter total revenue up 10% to £573 million, and it's reiterating its full year guidance. I guess much of that has already been woven in to the share price at 11.52. Interesting to see, though, where that stock opens up on the session this morning. One company I think is potentially going to see some upside trade this morning. At £38.70, Cranswick will open today after having published third quarter earnings, which basically repeats the mantra that we've seen, which has generated this rise in prices on its stock market listing. Key Christmas trading period was stronger than anticipated. The strong revenue from the first half of last year continued into Q3. Q3 takes you through until just a week or so ago. The group's adjusted profit before tax of the year, ending the 30th of March, is now expected to be ahead of the board's previous expectations. I'm looking positively on this, and I think we've got this green line here, which has been what it's been surfing recently. Hasn't traded below that 50-period moving average since August last year. Let's draw a little bit of a line on here to give you an idea as to where to put your stop loss if you're long on this. If you're long at £38.70, stop loss goes underneath the underside of that, around about the £38 level. £38.70 is where it's opening. Your price target would be 40.10. Things looking particularly good there, I think, for Cranswick. Not so good is what happened late last night, all sessions on the IG platform for Alcoa. The stock was down 5.5% after reporting its latest quarterly figures. There was an adjusted loss of 56 cents per share for the fourth quarter. Now, that on the whole actually was better than expected. Revenue coming in 2.6 billion in line with forecasts. But analysts were talking about the EBITDA level, which came in as a big disappointment for the company. Revenue with that dropped at 2.6%. Looking at what's been happening with the aluminium markets before we take a look at Alcoa, just to show you the markets in which it's trading. Big declines since the highs that we had back on the 27th of December. It really hasn't been a particularly good start for these base metals, and Alcoa suffering recently as a result of that. And you can see here all sessions on the IG platform building on that yesterday, indicating to those that look at these markets that we're going to see a weaker open when trade gets underway later on the US markets. Now, the global mining company BHP Group has released its production report for the last 3 months of 2023, and all is not looking good. Iron ore production falling by 2.2% to 72.7 million tonnes. That was in line. Copper production down 4%. Group operations also said it was reassessing the value of its nickel business because of the concerns about oversupply in the nickel market. Now, looking at what's been happening with nickel, prices falling 40% last year as Indonesian supply has been seen jumping, causing restructures and write-downs at nickel mines across Australia. BHP will provide more details in its half-year results on the 20th of February. But it's not the only one to take measures as well. This drop in nickel has hit other companies. Canada's first Quantum Minerals said earlier this week it will cut jobs and production at its Ravensthorpe mine in Australia. Savannah nickel project as well for Panoramic Resources, the Australian batteries materials producer, flagging in December it expects to book a further impairment to its Cosmos nickel project. So this drop that we got in the nickel markets from the highs that we had back on the 8th of December 2022, it really has been a story of pretty much one-way travel. We've got a drop of 52% so far on the price of nickel. And if it comes to pass that we do have this move that we've got on the nickel markets on the way down because of excess supply, this is going to mean more pain for these companies. BHP in today's session down 1.5% on the Australian markets. And that indicates to me of a potentially lower start when trade gets underway here in the London markets. Big declines in the London markets of BHP recently, resting at the 200-day moving average. I suspect we're going to get a break of that in today's session. There's an interesting market developing for oil. OPEC yesterday stuck to its forecast for a relatively strong global growth picture for oil demand in 2024. It said 2025 will see a robust increase in oil use as well, led by China and the Middle East. Now, this was a surprise announcement because it was expected to give its 2025 forecast in July. This view contrasts with ones of other bodies. The IEA, for example, this is the executive director, Fatih Birol. He told Reuters on the sidelines of the World Economic Forum yesterday he expected a comfortable, more balanced oil market. He's predicting oil demand will peak by 2030 as the world shifts to cleaner energy. The IEA expects a significant increase in oil output from the United States, Canada, Brazil, and Guyana later on this year, just as global demand growth slows. Now, that's going to increase supply. Is that going to give us some downside on the price? Let's take a look at what's happening with Brent, which is the OPEC benchmark. I've had this move here on the downside that we've had on Elliott Wave, and I'm waiting for a breakout of this triangle. When we get the breakout, if it's up, then the three-wave recovery is in place, and the projections are from the peak of this little symmetrical triangle here to take us up to 85.08. But of course, as we know, symmetrical triangles can break in either one or the other direction, and when you get a breakout, if it happens to be on the way down, you're then going to end up with oil then down at levels not seen since we passed that $70 level back in March 2023. So we're waiting a breakout and directional travel in the price of oil. Also of note that according to the API, US crude oil inventories rose by 500,000 barrels last week. Gasoline stockpiles fell by 2.5 million. Distillates rose by 600,000. Let's go back and take a look as well at what's happening with the price of gold. We've been talking a lot about the downside for gold. Gold is up today, but broadly speaking, holding on to the recent losses. We're resting at this 2004 level, which is the 61.8% retracement. So that's an interesting area to watch out for. You get a candle close below there, you're all the way down to the 1976, which is close to the 200-day moving average. So an area of interest for us technical analysts on the downside. Just a question of breaking the 2000 level on the way down, which I suspect could happen if we do get further gains in the price of the dollar. That's it. We're back at 10:30 with Charting the Markets. Do watch out for those UK retailers at the start of today's session at top of the hour. Still looking for small gains across some of those markets in Europe.